Men and women are equal. That's what we're
Yes,
supposed to. That's what we're supposed to believe.
they're equally fragile. But
Yeah.
yeah, no, it's crazy. Like I said, they're like, oh, so we're gonna honor the top female goalkeeper of the week, and they name her name, and she comes out of the crowd, and she's like literally limping to the middle. Like, and Catherine's like, oh yeah, in my group, like, because my daughter calls me on Thursday or Wednesday, and she's like, yeah, Dad, I got injured. A guy came down. One of the guys came down right on my ankle. Blah, blah. She's like, yeah. So I had to sit out the next drill, and it was like her and three other girls sitting out because they were all hurt.
Women work so hard to be equal over the last bunch of decades, and now they're no longer equal.
Yeah. Well,
Yeah, we gave you all these programs. We gave all this equality. We're going to start taking away by putting men in women's programs. Yeah, you can still be there, but we're gonna be there too, and we're gonna take it away from you. Like, yeah, good luck.
well, I will
Anyway,
say on the upside, I mean, I looked at it. I said, well, at least for this, if you can go against that when you get back to high school, soccer season, which is about to come up, I said you can take on anything now. It'll be easy. Like, I mean, all the people shooting on you will be like 40% shorter and about 60% lighter.
I will say, if you're used to playing with better kids, that does make you better. I mean,
It does.
it's funny. When I was a kid, I played goalie too. And when I was a kid, there was a goalie camp, and no one back then knew how to play goalie. No one,
Right.
People didn't go to camps. You just, like, you were good or you weren't good. It's different time. But I remember going, and it was awesome. I mean,
Mhm.
just like, I think there were like three professional goalies that were running the camp, and it was
Yep.
awesome. Like, it was so much fun, and it was challenging, but it was a lot of fun. I mean, the stuff you learn was just crazy for that age. So that's awesome that
Yeah.
you got to go, man. That's
This goalkeeper camp, I mean, the people have been coming back. Some people have been going for 10 years, and there's MLS players that came out of this camp. I mean, it is run by, like, I mean, D1 goalies and professional goalies. It's pretty intense.
that's
She didn't know
cool.
what she was getting into, but she said she has no regrets, which is awesome.
Nice.
So,
Cool. Awesome, man. Well, it is still summer. It is still in the doldrums. We've got the summer season, and
corn sweat season, Kirk. Corn sweat season for those in the Midwest.
yeah, I
Lots of
don't know what
fun.
that means, Doug. But
It,
anyway.
it, it means the humidity is about 100% because the corn are putting out about 5,000 gallons of water into the air every day.
Oh, okay.
So, yeah.
Okay. Yeah, we don't have that up in the Northeast, Doug. So there's different problems for different people.
You have
we,
lobster sweat season.
we had rain. We had
Yeah.
rain, Doug. So yeah, so summer. This is the summer, and once again we talk about this. The summer is a good time for reflection. It's a good time for stepping back and thinking about what you're doing, reflecting what you're doing, and realizing that really not much progress gets made in the summer. As we've noticed in the last few weeks, the markets were really high, and then they just took a hit because apparently Trump went back to war, or went to war. I don't know. I don't even know what the status is, but basically he said, all right, we're going to start attacking each other again. And then apparently they called a pause, I think this weekend. So oil's down like $10 from where it was. I think it was at 80, 84. Now it's down to 74. Markets are up a bit. But, what I find interesting is that regardless of what's going on in the markets, most people don't look at a chart. They don't understand what a chart is. What most people do is they look at the TV, and the TV says, "Hey, we're up 1% today. Isn't that great? Everything's awesome, and we're booming." And people don't bother to see how that relates to any other day in recent times. So I'm going to share that. I know this is a little basic, but I'm going to share it because I get this question so much, and I don't think enough people don't understand. So I don't want to be negligent in my role here as a free podcaster of information. All right. So this is the chart of the S&P 500 for last year. Okay, and I've got some extra lines here. You can kind of ignore them. But Basically, in the last year, the S&P 500 has gone up, and then during the war, it went down, and then it popped up. Right now, we're in this top area here with the two lines, the two horizontal lines. And those two horizontal lines are what we call a range. Now, the range is, I don't know the dates here on the chart, but the range is pretty much starting. The top was the beginning of June, actually the first day of June, and the bottom was 10 days later. And it's pretty much been within a range all of June and July, actually including parts of May if you go back to actually early May. So actually I should have extended this to May. So basically May, June, and July, the markets have been within a range. And what does that mean? It means that the market's not making progress, and that's normal, and that's okay. Because most markets don't go up all the time. Actually, every market doesn't go up all the time. But we all expect that, especially since the government has intervened in the market so much and allowed the market to slowly rise over time, as it has a lot in the last 2 decades. So when you start to see the market going up like last year pretty much every single day, and then you see it not going up, people freak out because the expectations are the market's going to keep going up. So when that doesn't happen, people lose their mind. Now, if we have a market like this where it's going sideways, people don't have expectations because it's going up, it's going down, people get frustrated. Well, as an investor, now's the time to just stop looking. If you're an indexer, just be clear. If you're an indexer, now's the time to stop looking. Go on vacation, enjoy yourself, because nothing's happening. There's no progress being made.
Wall Street's on vacation. You should too.
Right. I mean, the good thing about the summer is just take time off and take mental time off. That's what's important. Take mental time off, disconnect, stop looking, stop paying attention. The market is not going to change just because you looked at it. It's going to do what it's going to do. And frankly, if you're an indexer, you shouldn't really care at all. But if you're an investor in any other way than indexing, you probably are looking around. You're probably saying, oh my God, what's happening? You start losing your mind. Well, let me kind of make that a little easier for you. So that's the S&P. Here's the NASDAQ. Pretty much the same period. The NASDAQ doing the same thing, although it's at the lower end of this. The NASDAQ certainly is within a range, albeit the lower end of the range, which we'll talk about in a bit. And then, here's the Russell, which actually has been going higher. So the Russell has relative strength compared to the other indexes. And certainly we have looked at the Russell a lot. We like the Russell as an index this year. It's been doing well, and we think it can continue to do well. But I think it's important just to share where everything is. Now, we just started earnings season. I think we're into the 3rd week of earnings season, I believe. And we've seen some big company earnings come out. And, it's not been awesome. Even though the numbers have been great, the stock prices have not reflected that. And that does happen. And that is a warning sign. So we've talked about this last quarter, but it's important to recognize because it's happening. It doesn't always happen in earnings season, but it is happening last earnings and this earnings. So when you see a company report, you want to not so much care about the number it's reporting. You want to care about how the stock reacts to it. So if a company reports and the stock goes down versus, let's say, good numbers, let's say the street thinks it's going to get $1 a share and it gets $1.10, and the stock price goes down. What it means is the street was expecting a number that was much better than that. They thought it was going to be 125 or whatever it was. So the stock price goes down. I think a lot of people get confused when it comes to earnings because the company, there are numbers that the company whispers out to analysts and say, all right, we're going to have $1. Or there's numbers that the company will say, we think we're going to have $1 a share. Then there's whispers of what the company will tell analysts. Let's say it's $1.10. And then there's the expectations of everybody else. Everybody's like, yeah, they said $1.10, but they're probably going to hit $1.25. So there's multiple different versions of the expectations, right? The expectation, what the company says, what they're telling the analyst, because frequently they'll tell the analyst numbers that are more in line, because what they want to do is they want the analyst to be bullish and all these things. So they give the analyst a little peek under the hood sometimes. It's not necessarily illegal. They don't tell them the number, but they'll hint around things because it's just the nature of the game. And so they'll have a number in their head, the analyst, and then there's the number that everybody else thinks. The actual true, hedge funds, portfolio managers, people that in their head think, all right, well, these guys are going to get this number based on our expectations. So the expectation number of what the street's expecting versus what's actually given is why there's a discrepancy around earnings. So when you see IBM before earnings come out and warn, the stock price dropped 25% in a day. Biggest it's ever dropped for IBM, I believe. And it's a big company. It dropped 25%. That's big. It's big news. And so basically what they said is people weren't expecting that. They thought, oh, it's going to be great. And then they came out and warned. The stock got clobbered. So, we're starting to see that a lot with stocks. And I'll pull up a few charts here after Doug has a chance to chat and share with you that. But I think what's really important is to understand that the summer is a good time to take a break and just sit in the sidelines and do nothing. It's okay. But also understand that you want to watch how companies respond to their earnings release. Is their stock price getting crushed? Is it going up? Or is it just kind of going sideways? You want to watch how many companies are getting crushed and versus how many companies are bouncing on earnings. We're starting to see a lot fewer bounces than the surprises of companies, like bigger companies, getting crushed. And that's really important. This week, we're going to see some big tech earnings, which will be out of the Mag 7, I think about half of them have reported, and approximately the other half will be this week. And then there's one outlier, NVIDIA, which I think is like in 3 or 4 weeks. But the rest of them, I believe, half were 2 weeks ago or a week ago, and then the other half will be this week. So just keep that in mind as we're going through earnings season. Personally, I like to take this time and do a lot of reflection, a lot of re-engineering of what we're doing, and I don't watch the day-to-day so much because frankly of this. I mean, this is what I expected would happen most of the year, and it's happening this summer. But if you look at seasonality of volatility, this is where we are. The red is this year. So a little crazier than normal, but if you look at the last 35 years, these are the averages, and the red is really pretty much in line with where we are. So volatility will start to pick up from here until late October, which is normal. And by the way, when it says volatility is picking up, that means the market's probably dropping. Higher volatility typically means that the market's going lower. Not necessarily, but typically. So, if you start to see this pick up, which it normally does, you'll probably start to see the markets softening. So you're really not missing out in August, September, October. You're not missing out by, not being in the market all the time and glued to your TV and watching Jim Cramer, which I don't recommend. Just take a break sometimes. It's okay. We're in the worst performing of the 4 years in any presidential cycle, which is the second year. We're going into one of the worst times of the year, which is August, September, October. It's okay to not be invested. It's okay to sit in the sidelines. It's okay to take a break and not pay attention to the markets at all. It's okay. Now, Trump could warn that the war is over again for the 55th time, as he did. But, at the end of the day, we all know the truth, which is the war's not over, and it's not going to be over anytime soon. I think we'll probably be 2 presidents from now before it's over. But anyway, it is what it is. So whatever's going on in the Middle East and the impact it's having, just take a break. Just take a break from it. Enjoy your summer. Do something fun. Get your mind off it. Do some reading. I'm doing a ton of reading. I think I've chewed through like 11 books in the last 3 months. It's crazy. Been backlogged. And I'm doing a lot of reading, and it's great. Doing some catch-up work. It's a good time for that because once the fall hits, things get a little crazier. people get back to work. So take the time to enjoy the summer. We don't get, you don't get this many times throughout the year. Enjoy the ones you get. So what are you seeing this week, Doug?
Well, one of the things that that I'm seeing, and I think it's really important to consider is we still are feeling. I mean, besides what's going on in the war, which is the news. And by the way, you opened this today, talk about people seeing a 1% change, and I think that's a nice point to address because I think that is a concept most people don't understand very well at all. First of all, most people look at the markets and the 1% change. They don't notice that. They notice my portfolio went up by X dollars today. Or when it drops, it's like my portfolio went down by X dollars today. And one thing that I think is really, really critical to note emotionally is that the downside of having more, which is the great success of accumulation, is that you have to move your mindset to percentages because I saw it in the news again this week. It's like all of a sudden the market was down by 1% in one day. And it's like, oh my gosh, the markets are crashing, the billions of dollars that they just lost on a 1% move. The higher the markets are, the higher your portfolio is, 1% move is going to look like a lot more. I had a client years ago who inherited money. So this client went from not having a lot of money to all of a sudden having, over $1 million from an inheritance from her father, from her parents, from her father being the last one alive. And all of a sudden, a 1% move in the markets was a shift when she, only had tens of $1,000s away. 1% move in the markets was a couple $100, right? Now, all of a sudden, a 1% move in the market was thousands of dollars, and she couldn't handle it emotionally. It's like nothing's changed. It's exactly the way it was before. But that 1% now compounds to a bigger number, and when we have a good day, it compounds to a much happier number, right? You see that wonderful advancement in your portfolio by thousands of dollars, but all of a sudden we get a 1% reversal, and now you got $1,000 less. It is an absolute abstract number. There is nothing about the number of your portfolio that's actualized until you liquidate it, which again, if you're planning on moving from accumulation to distribution, this is when you need to do some serious revisiting to your financial plan because it is a significantly different impact. I've got, in terms of, I actually pulled something this week. Dave Ramsey, love him or hate him, but again, he's done a great job getting millions and millions of followers. Talks about a typical market return of 11.8%, and ultimately suggests that you could pull out money regularly, you'd be okay, etc. But had you retired in 1977, pulling 8% a year adjusted for inflation, as suggested, you actually would have found that you would have run out of money by 1993. Why? Because 1977 was the middle of the stagflation period. Between 1968 and 1982, the S&P 500, this darling S&P 500, actually averaged only about 0.4% a year, which is not great, right? And we went through this. We've talked about this before. The S&P 500 between 2000 and 2013 was also flat to negative. As a matter of fact, these great averages that you hear about, there's actual return versus average. These great average returns that we hear about are meaningless in these, in these cyclical cycles. While the secular cycle shows a great average return, you can get into periods where that return does not exist, and that it can be an incredibly different impact on how you're going to perform, and especially if you're going to start using that money, to live off of and start taking regular distributions out of your portfolio. If you haven't planned for how to work with that, it could be devastating. And in fact, 2000 to 2013 or to 2018, we talk about these great returns that are there. Market, it took 18 years for the S&P 500 to break 5% average again. All right. Now, Last couple of years, wonderful. I mean, you start adding 22, 25% returns, and you start looking. The problem is you start looking at that as normal, and that can create a very unhealthy psychology to these markets because if you go back and you were in a different situation in your life, that would create a completely different outcome. And I think that's really important as we get into this earnings season. As we look at where these markets have been going and how much money the markets have put on in a short period of time over the last several years, fueled again almost exclusively by the massive injection of M2 money supply into the markets that occurred starting in COVID. That doesn't go on forever. And now we take a look. I think it's something really critical going on. You mentioned the midterm elections, the war, right? These things do suck money from the economy. Now you start adding in the fact that AI is a bigger issue than I think people realize. Is there an opportunity out there? Absolutely. But nobody's figured out how to do it yet. The Nasdaq, from a charting standpoint, the Nasdaq just posted a bearish signal. Again, one signal does not necessarily indicate a pattern that you have to go make any decisions on them, but it's certainly something to watch. But it just confirmed a diamond pattern, which means that it's having a harder time getting any higher, and it's now starting to trend flat to potentially to down. We're also seeing that we've got a tremendous amount of money that's still sitting on the sides, which cash, which again, if that comes into the markets, wonderful. But we're starting to see more money being raised. We are starting to see money get taken off the table. And coming back to the AI, Kirk, I think it's a critical component to understand. Alphabet, Google, right? This is their new parent name that they've changed a couple years ago. For the first time in their history, they just reported negative cash flow or a negative free cash flow. Okay, so first time again. This is from their 10Q filing, July 22nd, 2026. Their capex exceeded their cash flow by $5.9 billion. What is that? That is fueled by the amount of outflow that's going out to AI, right? The AI giants also, there's reports coming out of major off-balance sheet commitments, $1.65 trillion in commitments. So their reported debt is about $1.35 trillion. Their off-balance sheet commitments about $1.65 trillion. What that means is, what is that? If we look at the AI demand, is it going up or is it going down? We don't know what the future is going to necessarily hold on that, but the amount of reported debt versus the potential debt that's out there that's being driven to fund the expansion, data centers and processing and all of that things that's needed out there. This, again, AI's here and it's here to stay. To what capacity? It's kind of the same thing with crypto, right? We go back 5 years ago, 5+ years ago, 5-10 years ago, all of a sudden the boom of all these different coins and cryptocurrencies, and you had NFTs and all of these crazy things are being put out there. Go back to the .com area where everything was just every company idea that could be thought of was just hitting the markets and IPOing, and that's the start of something. But what's going to float to the surface at the end? You're going to get a lot that's going to drown along the way. We saw this with NFTs. Still don't understand why you would literally pay hundreds of millions of dollars or at least tens of millions of dollars for something that you could literally just copy on your computer. But it is what it is. When people have dumb money to spend, they will do it. So now we've seen some things float out of that, and we're starting to see the maturation of a blockchain and crypto. Again, we saw the maturation of the .com era, and we've got, for every Amazon there was buy.com. We're now in that world with AI where there's so much invested into it. There will be a future. It's not going anywhere. But where is that going to end up? What's going to end up taking hold? What's going to anchor in? I think is a very critical is a critical thing to note, because when we talk about earnings season and we talk about what's coming in, what's coming in, going to be reported, the amount of spend The collective Mag 7 right now, I mean, they just shed 800 billion in market value in a single Thursday session. Okay. Now, that's a 1 day thing. The markets are moving around again. Can't really look necessarily at those dollar amounts when it looks at percentages, but we're starting to see Micron and SanDisk plunge 6 to 7% on Friday, right? So the semiconductor, is now, that we talked about how that been kind of carrying the markets. That's now off 20% from its summer highs. We just had some new tariffs go into effect. So again, there's been, like every time it gets used as a threat to get some negotiation power, then there's exceptions like in energy to protect from these rollouts. But again, that hits the news. Tariffs, raising of those made the markets shudder a little bit. Why? Markets don't like uncertainty. They don't like that, the uncertainty of Iran. They don't like the uncertainty of spending. If we start to see the earnings revisions coming in, we start to see this money that's going out for all of these different things, or profits getting suppressed because of tariffs or the war or, AI spending. That's when you have to be really, really careful about, and it can come very hard and very fast. Now you add in the fact that this is a midterm election and we're getting into that pre-election season. A lot of times that volatility, like you said, Kirk, happens in that third quarter right before those elections, because that's when the markets start to prepare for uncertainty. They don't like they don't like that lack of clarity. Right now, after earnings or after midterms, boom, after presidential elections, we see the markets do a lot, reverse or go in a lot of different ways. But leading up to that, again, nobody knows what's going to happen. There's a lot of speculation. Will the Republicans retain control? Could they lose it? Who knows what's going to happen there? And that ultimately will have an effect on the markets, both in volatility leading up, but also what's going to happen to the markets after. So I think, we are, JP Morgan just issued a warning that corporate earnings engine might be starting to run out of fuel. There's been plentiful upgrades, but the order to inventories ratio has been steadily declining for 3 straight months. We are starting to see a rotation of multiple tech and consumer discretionary groups. Again, those are down about 6.3%, have rotated in defensive enclaves. So we're starting to see a little bit more protection taking, a little bit more, trying to get away from this volatility. Just things I think that are important to note. And if you're going in this, like you said, just, riding the index is going to is going to bring us. We've seen what that's happened. And that's why when there's so much market cap driven into those indexes, when those darlings of those market cap darlings in the index, when they do really, really well, 5 to 7 stocks can make the index go to, massive highs. But when all of a sudden those same 5 to 7 reverse quickly, well, if you're in the index, there's nothing to protect you.
Yeah, no, it's good insight, Doug. I want to touch on, get back to some charts I was showing you before, and I want to share some things that happened in the past week, as Doug had mentioned. So this is a chart for Google or Alphabet, and what you'll notice is Alphabet dropped about 7-8%, despite strong growth, in large part because of their CapEx spending. Here is, here's Apple. So Apple, one of the few companies that is not spending big on AI, even though earnings hasn't come out yet. But Apple has been doing really well. I compare this to Google, it's been more or less going sideways. You look at Apple, it's been taking off, because not necessarily because their earnings are better. I mean, certainly things have improved a little bit for Apple because they've gone sideways for a long time, because a lot of people don't realize this. Their revenue and profits were not growing for like 3.5 years. I think they've come up recently, but for 3.5 years didn't grow. And people just assume, oh, Apple just goes to the moon. Like, yeah, but they're not growing, and they're supporting a really high PE, which is effectively what people expected to grow at, and it was zero growth, but yet people didn't care. That's the crazy market we live in. Now, normally, if you see a stock that's not growing for 3 years, you'd say, well, maybe the PE should be like 15 if the market's 20. But it's still supporting a really crazy high PE, which we'll get to in a minute. So Apple, which has not had that huge CapEx spending, has been rewarded. Now you look at Tesla. Tesla dropped about 14, 18% after missing earnings, reporting negative free cash flow. And the market didn't reward that. I don't think we're all surprised. I mean, Tesla is one of those companies that I'm never surprised at whatever comes out, because I don't know why it gets rewarded for this high price anyway, but it does. And this is why I don't like Tesla as a stock. It's just, it gets rewarded for things it shouldn't, all because people like Elon Musk. I like Elon Musk. I think he was doing great things, but I'm not going to invest in a company that's not earning money or even losing money. So, teach your own. But NVIDIA doesn't come out for like a month for earnings, but here's where it is. If you look at Meta earnings, I believe, are this week, but certainly, it's been going sideways for a while, but certainly not being rewarded. Here's Amazon. Amazon came out, I believe, Thursday, so it did not do well. You have Microsoft, which has not been rewarded for like the last year, because if you want to understand like the technology trends right now, people are investing in AI or things that are building AI. People are taking money away from software, in large part because people think software is going away because of AI. Software is not going away, but the problem is people don't understand how to value software. So take a company like Microsoft, which probably one of, if not the best software company in the world. And you look at Microsoft and say, oh, well, your revenues, your profits are going to be, I don't know, just make up a number, 100. And, we think next year it'll be 120, year after that it'll be 140. And we're just a very predictable cash flow growth. But you throw AI in there and like, well, how's that going to change your office suite? How's that going to change this? How's it going to change that? The problem is, you look at things like Copilot, people don't want to adopt it. They spend all this money on AI and no one wants it. That's the reality. And so people are punishing Microsoft. Does that mean that their revenues and their profits are going to decline? No. It just means that they've spent a lot of money. They're still spending a lot of money in this sector, and it's not going in the right place. And frankly, people are not rewarding software because they think that software is going to decline. If you think about, if you're willing to pay $20 a month for software, and now AI comes out, and you're already paying $20 a month for AI, you don't need the software anymore. I'll give you an example. I was talking to an accountant last week who's using AI in his practice, and we were messing around with, I think it was Base 44, I think it was called. Anyway, this platform that effectively takes AI and puts it into a dashboard, right? So I looked at it, and it's doing, if you look at your software, if you look at any sort of like cloud-based software, there's like a settings platform, right? And it's got like, I don't know, 40 different settings. It's got all these things. It's got, do you want SSO security? All these things. This Base 44 does all that. So you can effectively create your own software with AI. AI will do it. You'll create a dashboard. You don't need to pay into it. Now, this is an accountant, so we're talking about an accounting software, not picking on Intuit. But basically, you can create, and because he's using, LLMs and AI for accounting. He's not doing it, but he was explaining what can be done. He's like, it could be done now. He's like, most people won't do it because it's too complicated. But he's like, if I really wanted to, I could get rid of QuickBooks and just use this. That's where it is now. And people don't realize it yet. And people probably still won't change. But so using that, the question is, what's the value of Intuit? I don't know. Can they continue to raise prices? Probably not, because at some point people make that realization. I mean, look, if Intuit's charging me $50 a year for QuickBooks, and they're not, it's like a few $100. But if they're charging me $50 a month versus me going try to figure it out, I'll pay $50. But if they're charging me $500, maybe I'll figure it out. Maybe I'll figure out how to do it myself, so I don't have to pay them $500 a year for something that they're not, the product's kind of just average. The problem is they don't have any competition, right? So this is like a sample conversation people are having about software across the board. I'm picking on Intuit because I literally had this conversation last week. But you could pick any software and say, how is AI going to impact this in the next 12, 24 months? I don't know. But can they continue to raise prices for no reason whatsoever? No, they can't. So is their stock valuation worth a 40 multiple? Probably not. Which is why the software sector is getting crushed. And Microsoft is one of the better, if not the best, in my opinion, software companies out there. And you can't get rid of, their operating system because every computer runs on it. Can you get rid of Microsoft Office? Yes. Can you get rid of Windows? No, I don't think so. Not really, practically. So are they still going to have Windows? Yes. But are they going to have Office? I don't know. Hard to say. At the moment, yes, they're still going to have it. But are they going to have it 5 years? I don't know. I don't know what this looks like. And frankly, I personally still feel like this is a lot to do about nothing. But I'm also wary that it very well could disrupt the software industry completely in many ways that people aren't expecting. So, the theme on Wall Street right now for Microsoft and software is pretty much this. We like the prices, but we really don't know what's a realistic future price. So we're just going to watch. So you would think big companies would be in and buying up Microsoft hand over fist, but you know what? You'd be wrong. A lot of people on this show I've talked to, either on the show or even after and just closed door sessions, like they've all told me the same thing. Yeah, we're not touching software because we just can't price it. We don't know what the price is. We can't do any sort of discounted cash flow because we don't know what the future cash flows are. So they're literally just sitting on the sidelines till they can start to figure it out. And at the moment they can't, which means that software is still going to be in the doldrums until people feel comfortable with what that future holds. The problem is software, the SaaS model, was the best model around because you basically spend a little money, create software, and you get paid forever. And it doesn't really cost all that much to keep it running. It was a great model. So one of the best economic models in the stock market was the SaaS model. And now people have thrown it in the dumpster. It's a dumpster fire in regards to institutional investors. Does it mean it's bad? No, not at all. It doesn't mean it's bad at all. It just means that at the moment, people can't figure it out. So while it may look like a good bargain, and it may turn into that, this is why it's not doing better. Okay. So that's Microsoft. You look at Meta, which I don't understand their business model. I don't know how they're still in business or how their stock price isn't going worse. But as you can see here, clearly the market doesn't like their business model. Just from being on their platform and using it, I personally wouldn't touch Meta. It's, forget the cash flows and all that. They've had a few huge mistakes, with their Oculus, with their Libra project. I give Zuckerberg credit for trying all these things, but I think he's just missing the ball. I think he got really lucky with Facebook, and he's trying to diversify, but he isn't doing a good job of it. So I don't particularly like the company. I think they're fine if you're an investor, if you want to do that, but I just think that they recognize that they're not going to, their growth is limited and they need to find another growth source. And I haven't seen it yet. So not a big fan of Meta. If you look at Amazon, I don't know. I mean, I don't know what their growth rate is. Certainly the market doesn't like where Amazon's going. We'll find out this week. If that continues. I know since the quote unquote war is over, apparently everything's better. But I do think if we're looking at this week, we've got I can't look at two screens at once. So this week we've got Visa, Boeing, Coca-Cola, UPS, Ford on Tuesday. Wednesday we've got Microsoft, Meta, Qualcomm, Procter and Gamble, Starbucks. Thursday we've got Apple, Amazon, MasterCard, Coinbase, and then Friday we've got ExxonMobil, Chevron, AbbVie, and Moderna. So we've got actually, this is one of the biggest weeks of earnings season. You've got many of the biggest companies and most well-known companies all reporting this week. That's just a sampling. There's a lot more, but this is always one of the biggest weeks. So this is a week to pay attention. I wouldn't go crazy this week investing, but it's one to pay attention. So anyway, so that's Amazon. I think it's fine, but it's not, in my opinion, I don't think it's a huge grower. Then you've got, we already went over Microsoft. Okay. So we got Intel. So Intel reported last week, and Intel was fine, but the market didn't crush it. But it's and then the last one, we had General Motors report last week. Also, actually, General Motors did well in earnings. So, I would just watch earnings for how the market is treating these companies. It's important to understand how the market is treating them. Does the market, reward them, or are they punishing them for the results? And so this week will be very telling. And after this, it'll be a little more boring. You won't see as many big companies, but you'll certainly see a lot of companies after this. So anyway, what else we got on the docket here, Doug? Also, by the way, also this week we have Fed release. So I don't think that'll move the markets. I think it's on Wednesday is the FOMC rate decision. I personally think that the commentary will be interesting, but I don't think it's going to move markets. I don't think they're going to change rates. I don't think they're going to change rates at all this year. The market expects them to raise it 50 basis points. I don't think it's going to change it at all at the moment. I don't think they want to. I think it's going to send the wrong signal if they start raising rates. But if they get desperate, they might need to. We'll see. So what are your thoughts, Doug?
Okay, I am not muted. Yeah. Well, I think I want to just kind of talk about some signs that are out, some more signs that are out there. And sorry, I just moved my screen in. So my notes here are missing. But one of the things that I think is also just, I talked about some of the JP Morgan warning. I think some other, data points that to think about over the last couple, that are coming out over the last 7 days. There is an illusion of stability. Okay, so while the standard S&P 500 has hovered flat to slightly positive at points during the week, I think that there's been some signs that it was entirely masked by a few defensive heavyweights. I think that we've seen the S&P 500 equal weight index relative to the standard cap weighted ETF actually fell sharply over the last 7 days, and approached its lowest internal participation relative strength to its lowest internal participation relative strength levels since late 2008. So again, one of the misleading things about the standard S&P 500 is that it is, its performance is highly correlated to a very concentrated amount of companies in it. Again, that's why we call them the Mag 7, right? So basically, at most up to 10 companies have been really driving much of the returns the last several years. A way to kind of look at what's going, what really, is the underlying health of the markets is to compare the S&P 500 to how an equal weight version of it, the equal weight index is performing. And what it's telling you is that 80% of the individual stocks that are in the S&P 500 are actively dropping or stagnating beneath the surface. This is a classic late cycle indicator where institutional capital hides a shrinking handful of safe havens. Okay, and this is according to Barron's. I just put this out there. So, and Barron's, of course, of all the publications, is one of the ones that tends to try to get away from the noise and look at the data. So it's one of the better publications on what's going on in the markets. When you have a major break between the standard market cap S&P and the equal weight, it can tell you that even though things are balancing and the index is staying really high, and most people who just look at this, people are like, look, the markets are great. The reality is that there's a lot of suffering that's going on underneath the surface. And remember, there's a saying from Warren Buffett: you don't know who's swimming naked until the tide rolls out. Well, the equal weight index is kind of a way of looking. I was joking about this weekend because, I go to scout camp. I've talked about this a couple of times. One of the scout camps we go to is Tomahawk. The scout camp we went to this year is Many Point. Now Tomahawk's over in Wisconsin. Many Point's in northern Minnesota. Many Point is near is fairly close to Lake Itasca. That is where the Mississippi River actually originates. It actually starts as a small little creek, and you can see where the Mississippi River originates. We obviously see where it ends up, right? When it gets down to the delta, how big it becomes. The water up there is extremely pristinely clear. I actually lost my watch when we were in the water, and I didn't realize till I got back to the beach that my watch was missing. I walked out to where we were swimming, and I could look down through the water, and it was about, I don't know, about 5 feet deep. And I actually found my watch within minutes. I could see it at the bottom of the water. Okay, I could see through this. Now, if I had been at Tomahawk, where it's a soft bottom lake, it's muddier. When you walk, there's all sorts of sediment, the clouds. I would have never found my watch. Okay, Tomahawk is my analogy for looking at the S&P 500. You stare at it at the surface, and you can't see what's going on underneath. Many Point is my analogy for the equal weight. It is telling you what 80% of those stocks are really doing, and what, even though it looks really good from the surface, the reality is that you're getting, it gives you an X-ray to what's really going on beneath it, and there's a lot of unhealthiness going for most of the companies right now, that's showing you that things are not as pristine as they look from the top. If we go back to these tech giants, we look at where what's been driving this: the Amazons, the Microsofts, the Metas, the Apples. They're all, like you said, they're all reporting this week. But the thing I would be concerned about is any further capex surprises without any absolute proof of near-term AI software revenue can risk a structural tech re-rating. Now, you mentioned that there's seems a lot of confusion and uncertainty how to price software. The one thing that I would certainly say, if you're an investor, and again you're not thinking short term, is that one thing that Microsoft has continued to prove over and over again is they have an uncanny ability to weather most of this stuff and to shift. So I think from a long-term standpoint, if I were to look at companies within this that are going to figure out how to survive it, I would certainly put my money on Microsoft above anything else. But again, most people don't think that kind of long term, and we have seen companies that have survived decades as a leader, with the shifting of economy, a shifting of markets, a shifting of things, all of a sudden go away. Woolworths was the darling of retail for decades, and where are they today? So you never know when the adjustment or the change that's coming from a structural standpoint is going to end up being significantly problematic long term, and that could very well be the case with with Microsoft. So just again, be careful, because there is just like you mentioned with Meta, a tremendous billions and billions and billions of dollars are being invested into the hope that AI is going to be this future, but the return on that has got to come somewhere, and ultimately, again, massive correlation between earnings season and ultimately the markets. And so we start to see these weaknesses continue. We start to see some misses there. It may be maybe beneficial to those, especially that aren't necessarily looking long term, to be sitting on the side a little bit, or having some ability to maybe be a little bit more flexible. Because if it does pull back again, if you want to be able to truly buy the dip, if there's a dip, or be able to take advantage of the old saying, buy low, sell high, you got to have some liquidity to be able to buy low. Otherwise, you're just going to have to ride it out. So I think right now, when we look at big tech, this $5.3 trillion question is, are they, they're aggressively tap dancing on debt markets to fund unproven data center builds. And I think that's going to be, that's something that has to be at the front of mind of notes. And fixed income desks, again, what tells you about what's going on in the economy? The bond market. Fixed income desks are beginning to penalize massive corporate balance sheets over heavy capital expenditure. And we're also seeing, credit risk creep. Credit default swaps for hyper-cap mega infrastructure spenders like Oracle are surging higher. The other thing is, we are continuing to see a little bit of institutional complacency that we talked about. We're not necessarily seeing fund managers in general announcing that they think that the markets are overvalued. I mean, it's now hit I said this last week, it's hit a 7-year low. We're seeing institutional fear of missing out. you got to remember, and by the way, we also a chart that I just looked at, and I talked about this, I think last week or 2 weeks ago. Retail demand for stock leverage is surging, absolutely to some of the highest levels it's been. Banks have helped to facilitate this leveraged ETF surge. If you're a retail investor and you are trying to figure out how to continue to get these great, returns you've been getting, and they start to see that and you're all about the short-term return on investment, you start to see this late stage and very high risk pattern of chasing these returns by going deeper and deeper into leverage. That can be a trap. When that leverage pulls back, bam, that's when you start to see a massive return evaluation within the markets. But on top of that, you have to remember that professional allocators, now granted, we're in the summer, volume is very low right now. Smaller moves have bigger impact. But the pattern is showing right now that professional allocators are also completely trapped in a performance chasing cycle, despite these visible macro cracks. There's been minimal defensive hedging. That means broader market remains highly vulnerable to unexpected downside risks. Don't forget that these institutional managers are ultimately paid to perform. They're also paid by making sure that there's going to continue to be flows and demand for their ETFs or their mutual funds, or if it's in the institutional bank, investment banking, getting their customers to continue to buy their products. And investors don't want to put their money into something. They're very fickle. They don't put their money into something that all of a sudden isn't getting those same returns, because once you get a taste of the candy, you're going to want more candy. So it forces these money managers to stop looking at the fundamentals necessarily in the right way, and to make those prudent decisions, because they're getting pressure from the top two, from their organizations, to continue to be able to perform. And how they do that is sometimes you start seeing bleeding. So what they're investing in doesn't exactly match what the sheets look like. That's always a concern. It's like, hey, you're a large cap value fund. Why do you got 30% growth in there? Because value is underperforming, and money's moving out of our fund. So therefore, we're going to sneak these things in there to make the portfolio look better. But you need to understand, again, what's the who's swimming naked under those covers. If that's not matching up, that's a major risk, and they're missing their mandate. And ultimately, the companies at the top are saying, look, if these people start moving out of your funds, your returns are down, we're gonna penalize you for that, and that can create a bias internally to not necessarily be as prudent investing as they need to. I want to come back to the leverage ETF market. $200 billion in leverage ETFs, according to Bloomberg data. Now, banks are struggling to actually facilitate massive daily rebalancing flows for these leverage funds. Equity repo funding markets are facing extremely tight conditions as leverage demands drain dealer balance sheets. And so just keep in mind that a sudden market downturn can force mechanical daily selling, and that can compound the downturn momentum aggressively and quickly. So just, again, looking at the, what to do right now. Keep in mind that we're going to be coming out of this summer. We're going to be looking at a situation where we're going to maybe start finding that, as Wall Street comes back in, the other thing is they got to prove they got something to do. So you start to see some trading, you start to see some rebalancing, start to see some moves that'll happen early into third quarter, just to, basically in some way prove they have a job. And I think that ultimately can, naturally create some volatility coming into the fall. You add in the midterms there, you add in the risks of potentially missing on some numbers. And I think that we've, got some reasons where, as you've said before, Kirk, sometimes it's not necessarily a bad idea to be a little bit more sitting to the side and ultimately letting the others deal with that volatility, getting some clarity, and then being able to make some really prudent decisions. So anyway, I don't know if you want to say anything more, or if you want me to just wrap up, Kirk.
No, in the interest of time, we got to wrap up here, Doug. I did want to say one thing, but why don't you wrap up first?
Okay. I'm gonna keep this really quickly again. I talked about this a little last week. Just keep in mind that when we talk about what's going on out there, the real story isn't necessarily the wars. It's not necessarily AI, but it's ultimately what investors are trained to do. Right? They're trained to buy the dip. They're trained to be fully invested. They're trained. Don't miss the next rally. And increasingly, that's turned to investing into chasing. We're seeing it in the leverage ETFs. We're seeing it in the managers. Ultimately, borrowing exposure to stocks, trying to double, triple the daily move in the market. Why? The reason is again, the news out there is the train that, if you're patient, you're patient and you miss something, it's failure. Everyone else seems to be getting rich faster than you are. There's a dangerous psychological shift in where ultimately it's all about what you can gain, all about the accumulation you can get. And but you have to keep in mind, especially if you're moving into retirement, you have to keep in mind that the majority of the news out there especially on the markets, is ultimately designed for those in an accumulation mode, right? Driven by not only optimism, by fear, the fear of not the fear of losing money, but the fear of missing out. If you are going to be moving into the next phase where all of a sudden you've got to figure out where your money's coming from year after year after year, you have to understand what your money actually needs to accomplish. You have to understand that how much you're going to lose from taxes. You have to understand what it's going to be like to pull money out of the markets. I call this the field, when all of a sudden, hey, we're in a situation where what's supposed to be growing on the field might be suffering from drought or locusts. And if you're trying to go out there and feed off of it every single year, and it's one of those times, if you dig up the seeds, all of a sudden there's nothing left to grow, right? And so if you're transitioning, and I'm speaking to Gen X here, because we're now on the next wave of moving into that transition. Baby boomers are in there. The last wave of baby boomers are transitioning if they haven't already. Gen X, talking to you, if you're in that 5 to 10 year window or currently looking at how to get out, and we are stressed, we want to get out. We have a different view of looking at our retirement and our work life than the generations before us. And if you want to make that happen, then it's important to understand the taxes, your family, your state, your goals. How are you going to get this money out? How do you make it so you don't have to stress every year where it's coming from? And if you want to learn how to really structure this out, because distribution is completely different than accumulation. And at that point in time, do you really want the stress of worrying where your next retirement paycheck's going to come from? If you haven't planned this out, you want to learn a little bit more, check us out, mergentadvisors.net, MERGENT, mergentadvisors.net. Hope is not a financial strategy. Confidence is. Let's help you have that confidence not only today, but for the rest of the time, so you can live the life of purpose that you desire.
Awesome. Well, thanks for coming on, Doug. I did want to share one more chart here, and I'm going to keep it quick in the interest of time. But Michael Burry had sent these out. We were talking about the Mag 7 earlier. And this chart is PE ratios. So if you wonder why everything's sideways, these are not stock prices, these are PE ratios. So it shows in the past 10 years where the PE ratios have gone for each of these. Alphabet, Apple, Meta, which keeps going down. Sorry, you know what? I don't know why this isn't showing up properly. But anyway, so these are the Mag 6, apparently. And it just shows just how PE ratios have changed. So Apple's going up. I think this is Amazon, just from memory, because I don't know why it's not showing up here. But I also wanted to share this. He sent this out, and this is basically biggest spenders, CapEx spending. So you can see the biggest spenders, and is that being returned? Apple's certainly the smallest. Is that being returned? Not necessarily. So just something to keep in mind for all those of you who blindly just invest in the Mag 7, just assume they always go up. There's a lot of things going on right now with CapEx spending where, they're actually spending more than they're making. And that's in normal company, that would be bad, but people give them a pass because they're the biggest companies in the world and they just people assume that, well, they just have to stop spending on AI and it'll be back to normal. Yes, but will they? I think people are starting to realize that they're not going to stop spending on AI. I look at it as an extension of the government. The government wants you to continue to spend on AI, so we beat the Chinese. So these people are doing it, regardless of the value and the cash flow and the business model. But I think we're going to see a repricing sooner than later when it comes to the AI sector. I'm not saying it's going to crash, but I think there's going to be a repricing at some point. So I think people are starting to wake up to the fact that people are spending way too much money on AI, and we're not getting the results based on the expenditures, kind of like we did in the .com era. But anyway, so that's the show for this week. Thanks again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com, and of course, you can find me every week here on the show. Looking for the show notes and resources? Check out the show at moneytreepodcast.com. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you're seeking financial advice, give us a call. We take clients selectively, but only if we like you. So if it happens that we don't like you, there are plenty of advisors out there who will work with just about anybody with a heartbeat and two nickels to rub together. But we're selective. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.